Thank you for coming to the 2020 annual results presentation for CK Asset Holdings Limited. My name is Gerald Ma. I'm with Simon Mann, my colleague. Mr. Victor Lee and Mr. Edmund Ip will join us shortly. We apologize for starting this presentation late. As you know, we actually have a double session today, as we have made an additional announcement shortly after our result announcement earlier. What's going to happen is I will present our results as usual. Then we will take questions relating to the results from our online audience. Then we will actually go into the presentation for the acquisition and share buyback proposal that we have just announced, and follow with a Q&A session for that particular proposal. So without any further delay, I'm going to start the presentation right now. Okay. Final results highlights: 32.5% decrease in underlying EPS to $5.24. Dividend per share, full year dividend $1.80, a decrease of 14.3%. That's hopefully it's a better than what the street expected. Net book value per share 96.02, an increase of 3%. Our underlying profit for 2020 came to 19 billion, is a 32.5% drop from 2019. Three other items worth highlighting: fair value change in terms of our real estate investment trust interest came to $1 billion reduction. Investment property revaluation 945 million reduction, and pub related asset at impairment just shy of $1 billion, giving us the reported earnings of 16.3 billion. If you look at the chart on the top right hand side, you can see that from a revenue perspective, the biggest drop in terms of revenue came from our property sales division, a drop of 25 billion compared to last year. And the biggest increase in terms of revenue is a few months of contribution from our pub division. In terms of recurrent revenue in 2020 accounted for about 48% of our total revenue. In terms of profit contribution, again, the biggest drop from the same two divisions, 2.2 billion from property sales and 4 billion from the pub division, giving us a 27.8 billion profit contribution by principal activities. In terms of geography, 34% of our contributions from Hong Kong, 55% from the mainland, 11% from the UK and overseas. Again, on a profit contribution perspective, Hong Kong, we didn't have many bookings recorded in 2020, a 16 billion drop, but a handsome booking from our mainland division, an increase of 12 billion compared to 2019. Looking into each of the divisions, property sales, despite a 40% drop in revenue to 38.67 billion, profit contribution only dropped by 11% to 19.1 billion. And with margins solidly higher than our historical average at 49.4%. As I alluded to earlier, Hong Kong only provided us with 3.8 billion of profit contribution, although margin was very handsome at 43.4%. And China recorded a big increase from 2 billion in 2019 to 14.6 billion in 2020, and at an amazing margin at almost 54%. 606 million from overseas at a 23% margin. Major contribution from Upper West Shanghai, 6.5 billion. Le Parc Chengdu, 4.68 billion. Regency Hill, 719 million. And Harbor Glory from Hong Kong, 636 million. We still have 41 billion of contracted sales not yet recognized, and about 32.1 billion scheduled for recognition in 2021. Now, in terms of calendar year contracted sales, up to December 31st, 2020, we recorded a total contracted sales of $48 billion, which is significantly higher than 2019. 2019, we had about 26.7 billion calendar year contracted sales. Turning to property rental. 9% drop in revenue to 6.7 billion, 14% drop in profit contribution to 5.9 billion. Still a very healthy margin of 87.9%, affected by understandably increase in COVID-related expenses. Major contribution, Cheung Kong Center, 1.5 billion. 778 million from Whampoa Garden. Hutchison Logistics Center, 602 million. And a total investment property land bank, investment property portfolio of 17.2 million square feet. Decrease in fair value of our IP portfolio came to 1.1 billion before tax, and after tax is 945 million. Cap rates employed between 4 to 8%. Hotel division, 51% drop in revenue to 2 billion and an 81% drop in profit contribution to 260 million, which is actually one of the few companies who still enabled recorded a positive number, largely because of the hard work from our daily hotel division as well as our service apartment division being very steady. Most of the profit, all of the profit contribution came from our Hong Kong operations. You can see that we have a total of 15,000 rooms and service suites, breaking down occupancy for average daily hotel. The average occupancy rate was 20.1%. Average service suites occupancy rate was 86.7%. Now that's in pre-COVID. So for service apartments would be around 94, 95, and hotels always would be around 75 to 85%. Property and project management as steady as always, 42.5% margins, giving us 355 million of profit contribution. Aircraft leasing, now COVID restriction obviously hit us hard this year. 12% decrease in revenue and 26% decrease in profit contribution, and a margin of just shy of 40%. Now the profit contribution included about 200 million of disposal income, as well as 136 and 70 million of provisions and impairment of assets. Latin America had the worst performance mainly because of Avianca, Colombia, and LATAM, which both went through restructuring. We still have 125 aircraft, remaining lease term on average 4.5 years, average age 6.8 years. Hub operation, as a reminder, just shy of 2,700 pubs, 3 divisions, pub company, our own self-managed pub partners, essentially a leasing platform, and our brewing divisions with our own breweries in England and Scotland, and our own brands. 2020 revenue, a few months of opening in 2020, mainly the first two months and 2 months in the summer, gave us 9.5 billion of revenue. Profit contribution was negative, a loss of 3.4 billion. Out of that, 1.6 billion was depreciation, and 995 was impairment. So about 2.6 a billion was essentially non-cash. Infrastructure and utility asset operation. 1.37 billion of profit contribution from duets, which is a slight reduction from 2019 because of a lower green credit revenue and higher depreciation from EDL. For Reliance and Easta, 1.159 billion and 1.322 billion respectively, both recorded an increase from 2019 from organic growth momentum. Now I'll turn the next few slides to Simon. Thanks, Simon.
Thanks, Gerald. The group's interest in the real estate investment trust remain more or less the same. At the year-end day, it was 32.5% in the Weekend REIT, which own and manage 11.8 million square feet of hotel, service suites, office, and retail properties on the mainland, and 26.9% in the Fortune REIT, which own and manage 3 million square feet of retail properties in Hong Kong, 18.1% in Prosperity REIT, which own and manage 1.3 million square feet of office, retail, industrial properties in Hong Kong. For Weekend is an associate and make a contribution of 189 million to group profit for the year. For Fortune and Prosperity, the total cash distribution received in the amount of 300 million has been taken up as investment income. And then next we look at the group gearing for at the year-end day. The group has a total borrowing of 77.9 billion Hong Kong dollar, and the maturity spread over 16 years, with 22.9 billion Hong Kong dollar repayable within 1 year, 37.8 billion within 2 to 5 years, and 17.2 billion beyond 5 years. And then if we deduct our cash on hand, 59.5 billion Hong Kong dollar, give us a net debt of 18.4 billion. If we take the net debt to our shareholders fund, we have a gearing ratio of 5.2%. And if we take the net debt to net total capital, we have a gearing of 4.8%. Currently, our corporate ratings by Moody's is A2 stable, and by Standard & Poor's A stable. And then next we look at our total land bank. We have, at the end that we have 132 million square feet, with 80 million square feet under development, 5 million square feet in Hong Kong, 71 million square feet on the mainland, and 4 million square feet overseas. And we have 17 million square feet of investment properties, mainly 13 million square feet in Hong Kong and 2 million square feet on the mainland. And we have 9 million square feet of hotel and service suite, mainly 8 million in Hong Kong and 1 million on the mainland. And for the pub properties in the United Kingdom, we have 26 million square feet. About the land acquisition in the last 12 months, in May 2020, we acquired the site at Anderson Road, Kwun Tong, which will give us a developable gross floor area of approximately 1 million square feet. And in February this year, we acquired the Kai Tak area, 4E, Site 2 at Kai Tak, which gave us a developable gross floor area of more than 600,000 square feet. For the Q&A section, I'll pass it back to Joe.
Thanks, Simon. We'll be taking your online questions now, and similar questions will be aggregated and asked together. The first question is that the dividend drop is less than expected. What is your dividend policy going forward?
Well, dividend policy is based on our long-term view of profitability and growth prospects. So you can see that we feel more optimistic about the economy in the second half than in the first half of the year. That's why the drop in dividend for the final dividend it's smaller than the interim. Also, I mean, dividend is only one way of returning value to shareholders. Another option is the new acquisition and share buyback plan that we have proposed. That is another way of returning value to shareholders. So we hope by giving shareholders the choice, in the future we have more than one way of returning value to shareholders.
Thank you, Chairman. The next question, your gearing is very, very low. Which do you favor, increase dividends or share buyback?
Well, I'm not going to bind myself, but they're not mutually exclusive. So there's a possibility we can do both. But at the end of the day, the more important thing is the CK Group assets are solid and they are very secure assets. And when the economy or the virus situation improves, the assets are of good value. Sorry, I'll comment on that later on.
Another question is, what is your acquisition or M&A plan? Any particular countries you prefer?
We like countries with clear rule of law, and when it's safe for us to and safe for our colleagues to travel. But we look for secure return and countries that we feel comfortable with.
The next question is I'll ask it anyway, slightly out of turn. I understand that you challenged the regulator's determination for Northumbrian water in the UK earlier, and the results came out yesterday. Can you elaborate further?
I don't know whether the analysts understand the UK system. Some of you may understand well. There is the regulator for water, and also there's a CMA, which is Competition and Market Authority. And if you are not happy with the result of the regulator, you can appeal to CMA. Now, some people choose to take the regulator's offer. We don't think that's fair, and we appeal to the CMA. The result came out, and it's better than the regulator's original proposal. It's an improvement on the return. We're glad we appeal. I don't want to use the word winning or not winning things. This is hoping we get a fair judgment. And I think the result is acceptable.
I guess that question was relevant because CKA actually indirectly has 16% of interest in Northumbrian water through the economic interest arrangement signed a few years ago.
Well, it's a good news for the valuation of the assets contemplated in your acquisition and share buyback proposal, because what the CMA has confirmed is a reasonable return for utility assets in the UK, and that mark it's applicable not only to water but has relevance to other businesses. So it confirms a fair judgment of returns going forward for all other utility businesses in UK too.
The next question asked by a few analysts. There's been news reports of CKA obtaining approval plans for converting hotels into other users. What is your plan for these sites?
Well, converting to residents. Now we have got planning approval, but there is still a route where to go through on premium and the rest. But these properties are now operating as long-term stay service suites under the hotel category. So they're also giving us good return. So we'll select the best timing to convert them and provide much needed residence for the Hong Kong public.
Also, many analysts are interested in the answer to this question. Overall, Hong Kong office vacancy has been on the rise. Do you expect further drop in property rental contribution in 2021?
Well, there will be a lot of challenges generated by the virus and also the economy in the next couple of years. But if we're looking at our core portfolio, let's say Central, the beauty of Central is that when occupancy in Central edges a little bit higher, people from other districts generally will choose to move back to Central. When Central rent is too expensive, some people will move out of Central to the outlying areas. So Central will always be filled, obviously at a slightly lower rate, but usually the vacancy problem is worse in the Class B and Class C areas. Being in Central is not only convenience. Being in Central defines the reputation or the quality of the firm. So it's a face of the firm. So for a lot of companies, if there's a chance to move back to Central at an affordable price, a lot of them will. This has repeated over and over again in past cycles.
Next question, can we have your view on the Hong Kong, I think it's residential property market right now, and do you have further plans to buy land?
Well, we always have planned to buy land. That's why we are not only buy land, it's either through auction, in the rezoning that we do for our hotels, and also in the conversion of agricultural land to residential office land. Now, those are, in my view, also buying land, even though it's not as exciting as in an auction scenario, but the purchases are just as real. I don't have a crystal ball on future property prices, but we are optimistic. We've recently set 2 new records in our 2 condos at the Borrett Road property, and I think it sets a new record for Asia, 2 of the penthouses.
Next, 2 questions on the 2 sites we bought recently. Anderson Road looks like a very good buy right now. What is the margin for that site?
I'm not going to disclose the exact margin because it hasn't been sold yet. All I can say is that the architectural planning for the project has been done quite well, and we managed to achieve quite a number more units than originally anticipated. So the return will be above budget, and we're quite optimistic about the return on that project.
Next one is on the Kai Tak site. After your successful tender for the plot in Kai Tak, I think it's 482, the government announced the conversion of 5 additional commercial plots in Kai Tak for residential use. Are you concerned at all with the increase of supply?
No, not at all, because we know that those sites will be converted to residents. Actually, we would like the government to convert them to residents. That is a location more for residential than for offices, in our opinion. So it's going to be a better community. We know that. We know that before we know that that's the likely option for government to take before we purchase the Kai Tak piece of land.
So we'll do 2 more questions before I think Mr. Lee will have to join the CK Hutchison Q&A session. What is your plan on pub reopening? Do you expect Green King business to turn around this year?
Gerald, maybe you can answer that question.
I think based on the latest UK government guideline, there'll be a phased reopening in April, and then with full reopening, hopefully with very little, if not no restrictions in June. And so from a financial perspective, I think in the first half it will still be difficult, but we certainly are keeping our fingers crossed for a much better second half. Last question on aircraft leasing. With all the travel restrictions, what are your plans for this division, and do you have plans to buy more aircraft?
You can also answer that question, Joe.
Okay. Well, with 95% of our fleet being narrow bodies, they're largely used for domestic flights purposes, so which should be the first to find bottom and recover. As for international travel, will take some time, and the pace of recovery will largely be dependent on the vaccination process. In terms of buying new aircraft, it all depends on having the right return profile.
Okay.
I think that, yeah.
But one news that I can share. I think in your acquisition and share buyback program, later on, analysts and valuers will be looking at the valuation that we propose for the purchase of the infrastructure assets in UK. And those are done very fairly and a deal good for CKA. But one news that would be quite relevant is that actually it would be in the last 1 hour. National Grid have just announced that they have had an offer accepted by PPL for WPD. And the price in the announcement infers a REF premium of 73%. So that is a REF figure that's, I think, quite a bit higher than the one in the valuation model being used. That shows the quality, the value of quality assets. And as I always say, CK Group has a lot of quality assets, and at the right time, the values will be shown more obviously to our shareholders.
Thank you, Chairman.
You know about you've seen this news, right?
Yeah, we will do a full acquisition and share buyback proposal presentation to the investors right now, and then take your online questions related to this particular proposal.
Okay. I'll leave your meeting and go to the Hutchison one. Yes,
Chairman.
Okay, thank you.
If I can introduce, you can see on your window there is another gentleman who have joined us, Mr. Yusen Chiu. He is our head of special projects. He's responsible, is a leader for the project that we are about to discuss with you. So let's put up the presentation. Okay, so Yusen and I will do the presentation, and then Mr. Ip and Simon together with us will take your online questions. So have your questions ready, and I'm already seeing many. Now, this is the transaction overview. If you look at the top left-hand corner, the pre-transaction is the existing group shareholding and business structure. And on the right is if the proposed transaction goes through, that on the right is your post-transaction structure. The proposal comprises of two legs. First, a proposed acquisition, which this CK will purchase the target holdco for 17 billion. Now, the target holdco on your top left-hand corner, if you look at infrastructure, below which the target holdco actually has interest in 4 target companies: UK Power Networks 20%, Northumbrian Water 20%, Wales and West Utilities 10%, Dutch Enviro and Rural Energy 10%. Now, these are all very familiar assets which we, CKA, with the exception of UK Power Networks, already have an interest, in direct interest on. Looking at the right, the post-transaction, actually the interest on these assets held by CKA go from 0 to 20% for UK Power Network, from for Northumbrian Water from 16 to 36%, Wales and West from 12 to 22, and Dutch and Rural Energy from 14 to 24%. The purchase will be paid for via the issuance of shares at $51 per share, implying a 10% premium to average 10-day average closing price, and an 8.4% premium to the to today's closing price. Now, the second leg is a share buyback proposal. The proposed acquisition and the share buyback proposal are interconditional to each other, so they're linked and approved hopefully to be approved together. The intention of the share buyback proposal is to protect shareholders, to minimize or eliminate dilution. The company, CK, will buy back and cancel up to the maximum number of shares issued for the proposed acquisition above. And the way we will implement the share buyback proposal is that all qualifying shareholders, we are entitled to give their shares or tender their shares at $51 per share, and or not. It is at the option of the shareholders. And if there are any shortfall, then the company will attempt to do on-market share buyback to eliminate all or part of the shortfall at a price not exceeding the offer price, not exceeding $51, following the completion of the share buyback offer. Now, the overall effect actually is simpler than what I've explained. The overall effect is to deploy $17 billion of cash to acquire these cash flow generating assets. In summary, in terms of the deal terms, looking at the top left-hand corner, proposed acquisition, $17 billion. We will issue 333.3 million shares. Actually, it's 9 threes at $51 per share, giving us $17 billion, which again is 10% or 8.4% premium over the 10 consecutive trading days or the last trading date. And the share buyback proposal, again, hopefully buying back as the same number of shares at $51 as well. Now, the qualifying shareholders who accept the buyback offer, the share buyback offer, will also be entitled to receive the final cash dividend as well as the offer price per share. We'll be holding an AGM on the same date as the holding an EGM on the same day as the AGM, and the proposed acquisition can only be approved by more than 50% of votes cast by independent shareholders at the EGM, and more than 50% to pass the specific mandates. And the whitewash waiver actually will require 75% votes cast by independent shareholder. And the special deal, also 50% vote cast by the independent shareholders at the AGM. And the proposed share buyback offer, we need 50%, more than 50% vote cast by independent shareholders at the AGM. There are 2 additional elements we need to explain. In the bottom, you'll see one is called guarantee of cash distribution. The vendor, Li Ke-shing Foundation, will guarantee that the target holdco companies, the 4 assets target holdco company, will receive cash distribution of not less than 910 million Hong Kong dollars in aggregate, not less than, directly or indirectly, for the years ending 2021 and 2022, implying the $17 billion actually will be able to acquire assets that will generate a cash yield of not less than 5.35% in each of 2021 and 2022. And the CKA intends to distribute such amount in full to shareholders by way of dividend. The second element is the proposed dividend arrangement. Subject to the completion of the proposal, CKA will pay in dividends in respect of each of 2021 full year and full year 2022 total dividend each year will not be less than an amount equal to what we have just declared for the full year dividend in 2020, plus the cash distribution, 910 million that we talked about. Now, full year dividend came to about 6.648 billion. So add that to the 910 million, that means in 2021 and 2022, CKA is undertaking that the total dividend will not be less than 7.5 billion Hong Kong dollars. And the effects, if you do the math, is that the total dividend per share in respect of financial year 2021-2022 will be higher than the total dividend per share in respect of 2020, irrespective of the number of shares bought back pursuant to the share buyback proposal. So even if nobody decides to, because the share price has gone up so much, nobody decides to tender their shares back to the company, the dividend per share in 2021, 2022 will still be higher than the dividend per share in 2020. In terms of transaction rationale, there are overall there are four. This is a rare opportunity to acquire interest in a sizable, high quality infrastructure and investment portfolio without having to go through a public bidding process with very low execution risk, buying assets we already know how they will they have been performing. Second, we'll go to increase the contribution of our recurrent income base and boost the stability of earnings for the group. Three, and hopefully when the circular comes out and the IFA letter comes out from the independent financial advisor, it will show you and demonstrate that this is a financial accretive transaction. And fourth, this, for those who are interested, is a liquidity event providing opportunities for those shareholders to monetize at a premium to prevailing market price at the time of today's announcement. Also at a higher than normal market trading volume. To go into each of the transaction rationale with a little bit more detail, I'll invite our head of special projects, Yu Seng, to take it forward.
Thank you, Gerald. I think to go through the rationale, the first one that Gerald mentioned, this being a very rare opportunity to acquire, a quality asset. I think it goes without saying that I think if you look at the four assets, which should be quite familiar to you, three of which actually CK already own, and the fourth one is UK Power Network. Really, it should be characterized by quality, the stability of earnings. It all generate recurring income base. That's what CK is going after. And also, as Gerald mentioned, I mean, this is one of those situations where we have very low relatively execution risk. We don't have to go through an auction process, and we don't have to go through any other kind of competing with other bidders. And I will also draw your attention. Obviously, the newcomer of the portfolio is really UK Power Networks. It's an asset that's managed by CPI, and it's one of the top electricity distribution network in the UK. And it's also obviously an asset that we consider a very well-performing asset within the CKI stable. And it also happens to be a direct comparable to what you see actually very recently, just an hour ago in the wire, WPD, which was sold to National Grid. UKPN is basically a direct comparable to WPD, and you'll see in that transaction that these type of asset is very, very well bid, and you see the valuation. Obviously, it's quite attractive in the other transaction, and you can actually work out the RAV premium. So I think it's very important to draw attention to the quality of this particular portfolio, and to our a situation where we actually don't have to carry too much execution risk. The next slide. The second rationale that Gerald mentioned that we want to show here in this slide is really the stability and really the proven track record of these assets. You see from the chart, right? These are historical audited numbers published by these companies, and you see that it's obviously very stable. There's some growth. Obviously, these assets always benefit from some inflation growth and also from our strong operational efficiency. So you'll see these are clear data to demonstrate the stability over the last couple of years. Next slide. I think on page 6, right, you see that, as a result of this transaction, we will add to our recurrent income base, which is a stated corporate strategy of CKA. That's what we are strategically trying to improve our recurring income. It will grow after this transaction from 31.3% contribution. We will obviously get the benefit of the 910 million guarantee distribution, if not more, from actual operation, and also the 978 million of profit that this portfolio historically generated. So if you look at page 7, it is important to highlight this transaction is structured to be financially accretive. There's a couple of aspects to it. Number one is that the portfolio yields at least 5.35% based on the guarantee yield in 2021 and 2022. So in this very low interest rate environment, and considering the very low risk of these assets, it is quite a big spread over risk-free rate. Secondly, the transaction is also structured so that, as Gerald mentioned, there is a buyback, right, to go with the transaction, so that net, right, we're trying to acquire these assets with all cash. So in that way, the transaction hopefully will deliver accretion to the shareholders. Now, I just want to also, on this slide, elaborate a little bit on the earlier point mentioned on the proposed dividend arrangement. And to reiterate, assuming the transaction completes, right, the company will pay dividend in respect of 2021 and 22. That will be at a level not less than an amount equal to this year's total dividend amount paid, which is the 7.56 billion level. I'm sorry, the 6.6 billion level plus the 910 million. That is obviously also the guaranteed amount from the seller. So as a result, if you look at kind of the increase of the dividend, which is 910 million on 6.6 billion, compared to the increase of share count, possible maximum increase in share count, which is 333.3 million on 3.6 billion. One is more than 10%, one is less than 10%. It's pretty obvious that the transaction, even if we don't buy back any shares as a result of share price, as Gerald mentioned, or for whatever reason, it will still be a dividend per share accretive transaction. So it is important for us to ensure the transaction delivers a higher dividend per share to our shareholders. So to echo Gerald's last point, which is the liquidity point, the transaction, as you can see, at $51, the pricing of both the consideration shares as well as the buyback offer offers a premium to the historical share price, no matter how you look at it. Importantly, it's above our 52-week high. So this will constitute a new 52-week high share price at $51. It also really provides a liquidity event and exit opportunity for some investors. You can see that the amount of shares that we will be tendering under the general offer offers a material multiples in terms of compared to our normal trading volume. So for shareholders who want to exit, who choose to exit, this is a good opportunity if they so choose. So with that, I hand it back to Gerald, who will conduct some Q&As.
Keep your online questions coming. There are quite a few, so I'll be the moderator, and Mr. Eminit and Simon Mann, Yusing and I will do our best to answer your questions. First question, how did you determine the fair value for the assets you're buying from LKSF? It looks like a premium to the assets, premium to the assets compared to the most recent net asset value. Also, why not just buying back stock directly instead of through a transaction like this, when there's actually no net change in share count in the end?
For a start, we are somewhat restricted by what we can say, isn't it? I mean, the regulators won't allow us to talk beyond what we have made available in the announcement. What I can say, of course, is an arm's length negotiation. But apart from that, I don't know what else we can talk about.
I guess we can say that it is a very much an arm's length negotiation. CKA wants to buy recurrent income generating assets, and the counterparty LKSF would like to sell, but they didn't want any cash, and so if we issue shares, there will be a dilution, and so we came up with the structure to have two legs in this transaction, which is buy the acquisition, provide the vendor with what they negotiated for, at the same time protect shareholders by having a share buyback proposal, and like this gentleman asking the question said, there's no net change in share count if we are successful.
Yeah, at any rate, the IFA letter will come out later on, and together with the circular, and I think they will set out all the reasons why we believe that it's a fair and reasonable transaction, but it would be up to the minority advisor to explain why they also think it's fair and reasonable. I think we can't say too much at this point.
And Gerald, if you don't mind, just to add one point on the NAV. So obviously, due to listing rule and SFC requirement, we need to list out the net asset value historically. This is December 31st, 2020 in the announcement. But as you can imagine, this is the holding company SPV's NAV. So that amount also includes some intercompany liabilities. So when the full circular comes out, it will, when you see through the entire balance sheet of the SPV, you will see that this net asset value under incorporates liabilities that will otherwise be eliminated at completion. So I think this is a long answer to say, please bear with us. In the circular, which will be published around April 26th, there will be more details on what the last asset NAV is, and also the IFA's recommendation and calculation and breakdown in terms of their view on valuation.
The second question, can you elaborate a bit more on the share buyback plans and what are the considerations in setting the aggregate size of the buyback? I think you saying actually effectively answered quite a bit of that. Essentially, the share buyback plan, the purpose is to hopefully eliminate any dilution, buying back exactly the same number of shares at exactly the same share price as the offer price.
That's correct. That's definitely But on the other hand, even if we never able to achieve the full amount, it's still an accretive transaction.
And also the company will, there's an on-market purchase mechanism. If there's any shortfall, we will try to, if the market allows, we will try to buy back any shortfall and eliminate the dilution from the market directly?
Well, if the share price goes up, we may never be able to buy back anything. So what I'm saying is, even with not a single share, buying back is still a good deal.
The next question is whether it's a direct negotiation with the Li Ka-shing Foundation. Who negotiated with the Li Ka-shing Foundation? I guess it would be the people you're seeing, led by Mr. Ip.
The whole team.
The next question, we expected it. I think it's a pretty tough one. The company is buying assets from LKSF and issuing shares at $51 when the NAV is almost 91. Are you not issuing something way undervalued?
Oh, but that's a premium to the market price.
What I would say, maybe Yu-Seng can add it. If you look at, you cannot look at the asset acquisition or as one. You have to look at it in conjunction with the share buyback proposal. If you look at, because they are interconditional, one will not go without the other. So you should look at the two legs as one. But if you look at the two legs as one, the net effect is we are buying the assets for a great yield, a good yield, not less than 5.35% cash yield with cash, essentially.
So the way I would also ask people to think about this is really we try not to issue for exactly that reason, right? But we are sourcing secondary shares in the market, and the market happens to value us at that discount. And we didn't choose to have a share price of 47.05. I mean, the market gave us that number. So we are trying to source and acquire these shares from the secondary market on one hand through the buyback, and really satisfy the issue consideration that we'll need to satisfy our seller of these assets, which we obviously like very much. So that's exactly why actually the transaction is structured this way. We don't want to just issue the shares, knowing that it is at a discount to NAV.
So we cannot reiterate this point enough. It is we are essentially, the CKA would like to buy these assets for cash, not with shares. That's why this is a two-leg transaction. The next question, can I check whether how this 17 billion valuation stacks up against CKA earlier or initial acquisition when your earlier stakes were purchased?
Well, I don't know if this is a fair question. The foundation bought these assets a few years back. Yes, of course, he's made some money from the sale, but I think most of these assets have gone up in price. So even with a profit on the part of the foundation, the important thing is to look at what we're paying. $17 billion today on these assets. I dare say, can't quote me, of course, if the foundation goes out and look for a competitive offer, most likely he'll get a even better deal.
I think these assets actually, the foundation, the initial purchase was in before 2013, so it was quite a while ago. These assets have actually grown. The businesses are bigger, so it's not quite comparable. The next question, if the buyback does not succeed, again, we'll be issuing a lot of shares, hugely undervalued. Oh, sorry, I think we answered that question already. Next question. Can you explain in more detail the approach CKA will take if the acquisition closes but the buyback is not completed in full? Maybe you saying if you do you want to elaborate that again?
Well, I think as Gerald and Emil both mentioned, I think first of all the intention, if we don't achieve the full take up, the shortfall, we'll try to acquire it on market, for the next year, basically until the next AGM, at a price that's obviously not more than $51. So we're trying to achieve or negate the dilution impact as much as we can, through an on-market buyback.
I think that's all the questions. All the other ones are very similar. So these are all the questions. Oh, there's one more now. I saw that the announcement require 75% of independent shareholders' approval to get exempted for the general offer to all shareholders. What happens if the company cannot get 75% approval? I guess
the deal cannot go through.
The deal cannot go through. The entire deal collapse.
The transaction is interconditional, so everything needs to go through for the proposal to proceed.
The yield of this acquisition is quite appealing. But was the decision to acquire these assets also a desire to increase our earnings from developed markets, not just for return reasons? Or I guess what this person is trying to imply is whether we have another objective that we wanted to meet is to diversify further out into developed markets.
No, I think it's fair to say all the time our strategy is to invest in. Our preference has always been to invest in developed markets, where the risk is somewhat smaller and something that we're very comfortable with.
The cross-holding structure of many of your infrastructure investments are very convoluted. Is this a path to simplifying
Well, maybe you can say this is the first step.
Well, at least we're doing what you like, I guess.
What the eventual outcome, nobody can tell at this stage.
Will the infrastructure stakes, if successful, will the infrastructure stakes be consolidated onto the balance sheet and income statement?
Maybe Simon can answer.
Well, they're likely to be treated as associate or joint venture. We will reveal the terms of the existing the agreement between the existing shareholders, but it will not be consolidated because of the percentage of the shareholding will not reach the level for consolidation.
When the circular comes out, will we be able to see the look-through gearing post-transaction, since $17 billion of cash will be used?
Yeah.
I guess you certainly will be able to work out the look-through gearing that time. But we'll have another round with the investors, I'm sure, prior to the EGM with all the full information when the full information is available. It's from the same shareholder, a fund manager who thinks we are issuing shares undervalued, because he's saying we keep saying it's a two-leg transaction and it's one transaction, but if the stock stays above 51, he's assuming the stock just goes up and stays above 51, and we won't be able to people won't tender their shares to us, and we won't be able to buy in the market. Then there will be a lot of stock.
Well, maybe, but at the same time, the share price has gone up. So relative to today's price or the last 1 year, is still beneficial to the shareholders.
Well, I guess if the share price goes up, there's a reflection that more people like what's happening than not. So I guess it can be interpreted.
Even with a larger number of shares, and you know, it still stays above 51%, $51. That's good news for everybody.
Yeah. How is $51? How was $51 per share determined?
Well, if it's 52, you ask me the same question. So it's just an arm's length negotiation. A number is a number. That just happened to be the one that's been decided.
This one is not an easy question to answer. Can you talk about the rationale behind the decision to set the level of guarantee yield? Why was the guarantee provided? I guess they're talking about the 6.648 billion, which we announced as the full year dividend for 2020 plus the 910. Why provide that guarantee? And
well, it's the guarantee level is not something out of the sky. It's a level where the projects can generally return that kind of cash flow. But this is just to ensure that even if something goes wrong in the next 2 years, that the stream of cash flow will continue to come in. But it's not. I think if you look back at historical performance, these assets generally produce this kind of cash flow to the investor.
I think I would draw their attention to what we disclosed, 978 million as the 2020 historical pre-tax profit that this portfolio actually generates, to give people an idea in terms of where it's organic kind of profitability. And I think the guarantee provides kind of assurance, as Mr. Yip said, on the level of kind of distribution it can turn out. And also, the constraint that we can obviously give any sort of projections or forecasts. I mean, this type of situation.
The other thing I would add is an extra step to show that we are walking the path, so to speak. We say we want to increase recurrent income and generate stable earnings, and the two factual numbers, the 910. Are guaranteed by LKSF, and also what we just declared as a full year dividend. We are walking the path by saying we want to increase recurrent income, and we will pay that through to shareholder. So you will receive a stable recurrent dividend for the next 2 years, not less than the sum of the two numbers added together. Again, many questions on look-through gearing, so I'm sure we'll deal with it when the circular comes out.
Yep.
Long-term benefit. This is the last question. What do you think of the long-term benefit is? NAV per share will go up. Is that your objective? I'm not sure where he's coming from. Well, I guess NAV per share goes up if we run the business well and the underlying assets perform well, profits goes up. So hopefully this is like I said, with a financial accretive and a business improving, diversification improving transaction.
I don't know how to describe it, but long-term objective of management will obviously make sure the company performs well, provide as much profit and NAV improvement as much as possible. But I guess for the shareholders, the long range must be an increase in share price. So what we're saying is, if we perform our objectives properly, the share price will eventually go up, and hopefully that will be beneficial to all shareholders.
The last question is on pro forma NAV per share. If you are able to, if you're not able to acquire all the stock from the shareholders, but you are able to offset by buying in the market. So essentially, there will be the same number of shares as today if we are successful in doing our maximum in terms of tender offer, purchase, or make up the shortfall from on-market purchase. What remains is the same number of shares as today.
Correct.
That was the last question. We have no more questions. So I guess our much longer than usual investor presentation has come to an end. Thank you for the 200 plus people that have been participating, and I'm sure there'll be many more discussion when the circular comes out. Thank you very much. We'll see you. Bye. Bye.
Bye.